This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to the AJ Bell Money and Markets podcast. I'm Danni Hewson, and joining me to discuss what's been, let's say, another volatile week on markets is Charlene Young. Hi, Charlene.
Hi, Danni. Yes, we are recording this episode on the day Donald Trump is calling Liberation Day. We've not got details of his tariff plans just yet, though, because we're recording Wednesday afternoon UK time. But, we've already seen the impact of the uncertainty on market sentiment. As we step into the second quarter, we're going to have a look back at how markets have performed over the first 3 months of 2025.
It is hard to believe that it has only been a week since the Chancellor took to her feet in the Commons to deliver the spring statement, but already there is concern that her newly created headroom could, disappear. We'll chat through what the OBR has been telling the Treasury Committee, and of course it is tax year end. So Charlene's going to give us a roundup of what changes and what you need to do to make the most of your allowances. Plus, we've spotted an update from HMRC. Spoiler alert, the interest you pay on late payments is going up.
Yes, and we're treating you to not one, but two guests on the pod this week. First up, Emily Fletcher, Portfolio Manager for the BlackRock Frontiers Investment Trust, is on, which is timely considering how investors are perhaps looking for opportunities away from US markets, I should say. And with investors warming to bonds again after a patchy period where they didn't really comfort portfolios as expected, Dan Coatsworth is off to talk to Ryan Myerberg from the Brown Advisory Global Sustainable Total Return Bond Fund about all things fixed income.
A lot to cover. And as Charlene said, we are recording this on Wednesday afternoon, a few hours before we get the details from Donald Trump of exactly what his tariff plans look like and how, of course, the UK might be impacted.
Yeah, we're expecting a lot of coverage over the next few days. And as we know, the PM and the Business Secretary, Jonathan Reynolds, are involved in what have been described as intense discussions about whether there's a chance at all for a potential carve-out for the UK a bit further down the line. So we'll dig in properly next week, I think, once the dust has kind of settled, because actually, Danni, we can learn a lot from looking back, can't we? Q1 of 2025 is over, and it's been a doozy.
Oh, it really has been a doozy. Start with US stocks because they have come under some serious selling pressure this year. The benchmark S&P 500 and tech-heavy Nasdaq falling 10% from their record highs last month and confirming a correction. Just looking at last month, the S&P 500 shed 4.6% in the first quarter of 2025. Now, let's give that some context because it's its biggest 3-month decline since July 2022. And of course, over here, we're focused very much on UK markets. And I was taking a look at the FTSE 100, which, at the start of the year, we started to see records falling and it was doing incredibly well. And I think it's really important to note that it is still up more than 5% since the start of the year. But over March, some of those gains have really been clawed away, with the blue chip down almost 2.5% over the month. And unsurprisingly, under pressure today, as are European markets, Asian markets, and of course, US markets. And it's been really interesting to sort of try and clock what the impact of tariffs might be, aside from the obvious, because we've had a really good earnings season, but investors are already looking through that and they're taking note of the outlook. And we've seen, particularly big box retailers in the United States like Target and Walmart warning that their sales are likely to be impacted by tariffs, that consumer confidence is waning, that they may have to put prices up. And of course, all of that then impacts inflation as well. I was really caught by news which came out of Virgin Atlantic the other day. It said that it had seen a slowdown in demand over the past few weeks of passengers wanting to fly between the UK and the United States. On the one hand, United States operators, well, they were saying, well, maybe we're not going to get such a great reception in the UK. And of course, on the other hand, UK holidaymakers, businessmen and women are maybe thinking that now is not the time to go to the United States. I've heard quite a lot of people speaking on different radio programs over the last sort of week or so saying that, quite often they would consider a trip to Florida, but just at the moment, maybe they would be looking more at Europe. And one of those reasons is because grocery prices are still so incredibly elevated. So it's quite interesting to see what is being impacted already, like travel stocks. And we saw under pressure the likes of Delta, United, Airbnb, Expedia. And of course, over here, we had the British Airways owner IAG and EasyJet also being impacted as well, with people considering that maybe if there is a recession in the United States, or a global recession, which of course, we've had warnings about, because if you throw too much grit in the wheels of that big trade engine, it is likely to skid, to stall, and that is likely to impact not only growth, but also inflation as well. And I know over here, so many people are just fed up to the back teeth of the word inflation. Donald Trump may think that tariff is a beautiful word, but I think over here we can all agree inflation is, well, possibly one of our least favourite words. Now, we know that Downing Street is really hopeful it's going to be able to carve out some kind of deal for the UK, but it's been notable in the past 24 hours that the noises coming out of government spokespeople's mouths sounds a little bit less confident than it has before. And certainly we're not expecting a deal today to be done. We've had Donald Trump saying that he's not going to use tariffs as a negotiating tool. But do you remember we were talking about TikTok, it going dark? I mean, it wasn't that long ago. And you know that the 5th of April is the deadline when a buyer has to be found for TikTok in the United States, or guess what? It goes dark again. Well, from what we can understand, tariffs are likely to be the biggest bargaining chip that Donald Trump has in order to try and make some kind of deal go through. One of the most sort of obvious potential buyers, Donald Trump says there are lots of people interested, but one of the most obvious ones is Oracle, which is already TikTok's primary cloud provider. So that could definitely be one of the deals which could get over the table. But, seriously, it does just raise questions about exactly what Donald Trump is doing, what his aim is, and whether there really are deals to be made.
Yeah, absolutely. And you mentioned the kind of noises and the change in messaging over the last 24 hours. And, whilst the EU might still be kind of looking for a robust reply, perhaps, I really did notice over here in the UK, it's more talking about no knee-jerk reactions rather than that kind of hope for a deal. So, yes, I think, anyone who pretends to know what's going through Donald Trump's mind is maybe not completely being honest. Like we say, sometimes, he likes to surprise, that, he likes to toy and play with people. So, we shall see what happens in the next few hours, because it's not far away. And you mentioned, Danni, you mentioned wheels earlier. One of the sectors that's been really impacted as well has been vehicle manufacturers.
Yeah, I mean, it seems incredible to think that it was only a week ago that you and Dan and Laura were sat down having a chat about the spring statement and talking about the fiscal headroom that Rachel Reeves had created, and the warning that with tariffs, that could be wiped out. And certainly we've been hearing more from the OBR this week. We'll talk a little bit about that in a moment. But it was almost no sooner that she sat down than Donald Trump came out and said, right, I am now going to place tariffs of 25% on all vehicle imports into the United States. Doesn't matter where they're from. If they're coming into the United States, they're not made in America, they're going to be subject to this 25% tax. And of course, not just vehicles, but also car parts as well. And we know what that global supply chain looks like because we experienced what happens when it all goes wrong following COVID. And those car manufacturers operate those just-in-time manufacturing processes, which require free trade to move swiftly and easily and cheaply around the globe. So it's interesting to note that he has said that the tariffs on car parts won't come in immediately. They will come in a little bit further down the line, maybe. So that allows some of the US car makers to try and maybe take a look at some of their inventory, maybe take a look at some of their processes, their supply chains. But yeah, immediately we saw car makers, European car makers, Stellantis, um, Porsche, Mercedes-Benz, BMW, Volkswagen, all down. You're talking about billions being wiped off the value of these car makers. And of course, it also impacts us here in the UK as well, because the US accounts for 16.9% of all exports, worth 6.7 billion for British car makers. So we did see, the likes of Aston Martin really taking a hammering in terms of its share price. In fact, it lost 6.6% on the day, a record low it reached, though it has pared some of those losses after the announcement of a big funding injection, as its chairman sells its stake in the Formula One team that he owns. And just today, we've had a warning that up to 25,000 jobs in car manufacturing in the UK could be put at risk. Now, this is research which has been conducted by policy experts at the Institute for Public Policy Research. This is if Donald Trump does proceed with this 25% levy that he has said that he is going to put on cars as expected. But we know that deals are in the offing. And even now, as we're recording this, there are reports that a potential deal is being struck with India. It plans to lower import tariffs on electric cars. And of course, who potentially will that benefit? Well, the first bro, of course. We've got Elon Musk with his Tesla business, which could be part of that first tranche of tariff reductions if a planned bilateral trade deal is signed off. So, yeah, we're going to keep a really close eye on that.
So with all the chat about the restored headroom perhaps disappearing again for the second time, we've seen the budget rumour mill kick into action, really early. We don't have the date for any autumn budget just yet, but we have seen stories in the national press about, where Rachel Reeves might have to look next, given that she's really doubled down on her non-negotiable fiscal rules. But, with all that chat about what might come in the future, we're obviously... most households are really concentrating on their situations right now. And we've seen a lot of bill rises that have just hit us from yesterday in what has been dubbed awful April. So to quickly run through these: council tax. Most councils putting their bills up by 5% in England, but some, including Somerset, where I was born, have had permission to increase by even more than that. And also listeners in Scotland and Wales will also have seen bills hiked by more than 10 or even 15% in some cases. Kind of sticking with property and stamp duty and those what were temporary uplifts in the amount that you could buy a property for before stamp duty kicks in, that's gone now. So those thresholds are coming back down, starting at £300,000 for first-time buyers and £125,000 for everybody else. Water bills, they vary quite widely across the UK, but on average up £10 a month. Energy, again, for most people who aren't on a fixed tariff, that new energy price cap kicked in yesterday, around 6.4% higher for most people on that. Standing charges up for gas as well, but actually down for electricity. Car tax going up, including now for electric vehicles. So it depends on when your car was registered, but most electric vehicles will now be subject to the standard £195 a year. National minimum wage is also going up. Good news for those who are on it, but of course, businesses are going to have to find some extra cash, as well as the higher employer national insurance costs kicking in as well. And, food prices ticking up at a faster rate too. So we've had some data from Kantar that shows that annual grocery price inflation was 3.5% in the 4 weeks to March versus 3.3% in last month's report. Now, as well as the kind of pressure on our pockets, these rises feed through to that main inflation target and, of course, the Bank of England's target. So it's worth mentioning, though, so far markets are still pricing in a 70% chance of a rate cut at the next meeting in May.
Yeah, it's going to be interesting to see what happens with that next meeting, because I think a lot of people think that if the Bank of England is going to act, it needs to act in May, because you've got no idea what either inflation or growth or the world economy as a whole might look like by the time we get to August. So if it doesn't take the opportunity to make a cut then, it might be, having to be put off into the never, never. I mean, such is where we are in terms of complete unknowns. It really is quite unsettling at the moment. And as I said earlier, I think a lot of people are just really fed up with the world inflation. And one thing that it's done is it's sparked expectation of supermarket price wars. And I was taking a look yesterday as we got those Kantar figures in, because we had both Sainsbury's and Tesco, which are obviously listed grocers. Their shares came down despite the fact that they had increased their market share. And that is because of expectation that Asda is going to fight back and the battleground is going to be price. So potentially we could see all of us, the consumer, being winners here, although we're already looking for those deals at the moment. I think it was something like 28% of all sales were done on promotion over the past month. So, something to keep an eye on. I just wanted to round off our market segment, taking a look at a couple of bits of market news that have caught my eye this week. And I'm going to start with the IPO of Newsmax, which is a conservative television company. It launched on the New York Stock Exchange on Monday. Since then, have a guess, Charlene, how much its shares have gone up by?
Well, I feel like I might be cheating a little bit, because I think Dan has taken a look at this and I might have seen it earlier. If it's the same company, I don't think there's any other Newsmaxes. Isn't it something wild, like 600% or something?
More than 2,000%.
Oh, wow, I was way off. Sorry, Dan. I clearly not read your note properly.
Absolutely incredible. I mean, it was initially priced at $10 a share, and at the end of yesterday's session, it was trading at $233 a share, which gives it a market value of $30 billion. And if you consider that then surpasses Fox Corporation, of course, home of Fox News, which is a big rival, Warner Brothers Discovery, and Paramount Global. Now, this is incredible. And of course, a lot of it is down to the retail investors. So I've seen a lot of coverage of this story where people pointing to that sort of meme stock craze, where we had the likes of GameStop, which is the video game retailer, which saw its shares absolutely jump up during the pandemic and then has really struggled since to try and sort of repeat that success, has lost a significant amount of its share price. Now, this is a company which is seen as friendly to the White House. It was toasted by Donald Trump, who said that he was, supporting Newsmax. This was at a time when he was a bit on the outs with Fox News. It's a company that earlier this month paid £40 million to settle allegations that it defamed the voting machine company Smartmatic by reporting false claims that it helped rig the 2020 election for, of course, Joe Biden. So this is a business which a lot of people are thinking that with Donald Trump in the White House is likely to do incredibly well. But when you consider the market valuation and you consider the company and you compare it to other companies, well, yeah, I mean, it sort of doesn't add up, really. It
No.
really has gone.
And that's very unusual for, an IPO valuation to go that much under. That's just crazy.
Yeah, and there are certainly some interesting stocks, obviously, out there, including Donald Trump's own media company, which has been a lot of discussion about and a lot of investor interest in. I just wanted to end by talking about a potential takeover bid. So, US chip maker Qualcomm has said that it is considering making an offer to acquire Alphawave, which is a UK chip company. Now, Alphawave designs and licenses semiconductor technology for data centers, for networking, for storage. And we know that Qualcomm is really sort of pushing further and further into this space. And I thought it was really interesting that this deal might go ahead. Qualcomm saying that, yeah, it was taking a look at the deal. Obviously, it's now got until later in the month to make an official offer. But with all the noise of what's going on with tariffs and the fact that there really has been a period of time when investors have sort of fallen out of love a little bit with AI after it being the only thing that they wanted to talk about last year, the fact that we're still seeing behind the scenes this kind of deal making potentially going on sort of hints a bit as business as usual is continuing, and that companies and investors are still seeing the value in AI. When you think about potential productivity gains, the fact that they are still prepared to spend on AI, I think, is a really interesting business story at a time when there's, not much else going on, right?
No, I don't know what you mean. So, as we've been talking about volatility in US markets and the concerns about potential impact from tariffs, has that made investors consider kind of diversifying into other regions if they hadn't already? So, with that all in mind, we thought it was a good time to catch up with Emily Fletcher, who is portfolio manager for the BlackRock Frontiers Investment Trust. Now, as the name suggests, the trust focuses on companies from less developed countries that might have been overlooked by many investors but could deliver long-term growth. Let's hear from Emily now.
Thank you so much for joining us. I suppose a lot of people might be wondering, as a jump off point, what is a frontier market?
Fantastic. Thank you so much, Danni. Yeah, it's a really good question, actually, and one we've thought about quite a lot over the last few years. What we would say, and how we define our universe, is that there's somewhere around 200 countries in the world. Of those, there's around 20-ish countries which are defined as developed markets. And then everything else below that is emerging and frontier. So we don't invest in the top 7 largest emerging markets. So we don't invest in China, Korea, India, Taiwan, South Africa, Brazil, and Mexico. And we would invest anywhere else in any other countries that have markets or that we can access anywhere else in the world. So we invest in the smaller emerging markets and everything below that. And we think that's a really interesting universe for a couple of reasons. The first is that these tend to be markets that investors don't have much exposure to in their portfolios. And fund managers, institutional fund managers, don't tend to spend a lot of time looking at. So we think that those top 7 markets in emerging markets that I mentioned are something like 90% of the benchmark in emerging markets. And I think that most emerging market fund managers would spend 95% at least of their time looking at those top 7 markets. So when you step below that into what we consider our universe, then we think that you have markets which are generally under-researched and not that well known. And that is a really exciting place to be investing, because I think for an active manager, that presents the ability to add lots of alpha when you're investing in those countries.
So there might be some people that are getting some kind of map of the world out now and trying to figure out which countries you're talking about. Just give me a couple of names of some of the countries that you're talking about.
Of course. So some of the larger countries we have in our portfolio at the moment will be anything from Saudi Arabia, Indonesia, Thailand. We have some Latin American countries. We have a bit of Chile in the portfolio at the moment. We have had Colombia, Argentina, And then some of the Eastern European markets at the moment, it's quite a large weight in Poland. We can have Greece, we can have the Middle East, UAE, a little bit of Africa. So it's a really exciting and very diverse universe of countries that we can invest in.
I think some people hearing that might be surprised, thinking of Poland and Greece as frontier markets. It is fascinating, and I would imagine incredibly diverse. So I imagine that means that there's an awful lot of sectors involved.
Yeah, there's a huge amount of sectors involved. And really, it just covers the same sectors that you would expect to find in more developed markets. So anything from banks to property companies to technology companies to consumer companies, healthcare companies. It's a broad sector remit, as you would find in more developed markets. We do, in our index, have a higher prevalence of financials than some of the more developed indices. But actually, we think it's really important to differentiate that a lot of them are really simple banks and a lot of them only operate in a single country. Now, and that's quite an interesting factor about quite a lot of our universe. And I think quite typified by the banks. If you were to take the big global banks, such as a JP Morgan or a Credit Suisse or an HSBC, the likelihood is that all of them will be quite highly correlated. They all operate in a global sphere. If you step down into a bank in Chile, a bank in Kazakhstan, and a bank in Kenya, say, they would likely have very little economic linkages between them. All of them will be driven by what's happening in their local country, their local economics, their local politics, whether or not loan growth is growing in that country or region. And if one goes up, it probably tells you nothing about what's happening to the performance of any of the others, because they'll all be so driven by the local factors. So therefore, although it is a sector that in bigger markets is quite globally correlated across markets, we found when you step down into our universe, actually it becomes very much a local sector more than a global sector. And hence, although there is a higher weighting of financials, I wouldn't take that as meaning that you should look at that as a homogenous sector in our universe.
That must mean an awful lot of work then. If you can't correlate, within a sector, that's a lot of boots on ground.
It's a really, really interesting place to work. It really is. And I'm very lucky sitting at BlackRock in the benefits of sitting in a large global emerging markets team. We have a large number of analysts who help us look at global emerging markets, and obviously sit in a firm where we have big emerging market debt teams, currency teams, infrastructure teams. And that having that to be able to call on this background is really helpful. But I don't think that negates from the fact that as managers, and I have two co-managers on this trust as well, Sadaf Niaz and Sam Vett. And as managers, we do need to spend a lot of time traveling, spending time on the ground. We believe that having worked on this trust since 2010 is a huge advantage in having developed those relationships, worked out, who to speak to in a lot of these countries, and spent a lot of time invested already just understanding some of the background, political, economic context to the stocks that we invest in.
So you've been doing it a long time. How does performance over the past 12 months compare with performance the previous 12 months or the past 5 years?
Sure. So performance over the past 12 months has been, I'd say, okay. I think the fund is up 6% over the last 12 months, compared with the benchmark for us up about 2.5%. So it's outperformed its index, but it's been okay, I think. On a 3-year basis, I think the fund's up just over 30%. And so a more interesting return over that slightly longer time period. I think with frontier markets, it's really important to have that 3 to 5 year time horizon when investing, and I don't think performance is normally linear in these markets. But it has, for us, been a really good period, actually, of both absolute and relative performance over that 3 to 5 year time horizon. And we've been really pleased, touch wood, with the performance that we've generated over recent years.
That 3 to 5 year time horizon, is that a way to sort of mitigate risk? Because I would imagine investing in frontier markets where there are an awful lot of variables at play does mean that there is more risk built in.
So this is a closed-end fund, and we think that the closed-end structure is really, really fantastic for investing in frontier markets. That's for a couple of reasons. And the first is exactly as you said, these markets are less liquid. So everything we have in our portfolio does trade every day. You can value at the Bloomberg terminal in 10 seconds. Almost all of our stocks trade at least $1 million. So it's not an illiquid portfolio in that you couldn't exit it, but it is a portfolio that is less liquid than you would find in more developed markets. And so what the closed-end nature of the trust means is that we can invest in exactly the stocks we want to and in exactly the countries we want to at any given point without having to overlay on the top of that liquidity concerns about flows and whether or not there's money coming in and out of the fund every day. On our platform, we don't run an open-ended fund alongside. We only run the closed-ended fund because we think it's such an ideal structure for this universe. Because we have that flexibility, therefore, we can take our view on our 3-year time horizon of exactly where we want to be invested, exactly which countries, exactly which stocks, and we can put the trust there, exactly as I said, without those liquidity concerns. And we think that's really important because you do get drawdowns in emerging and frontier countries, in individual countries every year. And because of that, we try to allocate the trust quite dynamically from year to year. So all of the countries that are currently in our top three, that were in our top three sort of periodically every 6 months back over the last few years, we've also had zero in. And we do move the trust really dynamically in and out of the countries that we want to be in. All of these countries go through economic cycles. Those economic cycles in this area of the world are not homogenous. They don't go through them at the same time. And that's really interesting because it means there'll always be some countries going into recession that you don't want to be owning, and some countries that are just emerging out of recession, starting to grow really nicely, that you do want to be owning and you want to be sort of adding weight into and increasing the size of your investment there. So that dynamic overlay, I think, is a really important part of what we do in determining not only the companies that we want to be in, but the countries that we want to be in. And so, yeah, we really feel that the investment trust structure that we have is really important for frontier markets.
Do you think that people's attitude to frontier markets has shifted over the past few months? Because I know we've seen a lot of rotation out of particularly US stocks where there was a huge amount of interest over the past 5 years, 10 years.
I think that we have seen some rotation in global markets. I'm not sure I would go as far as saying we've seen a lot of interest yet in these countries and in these markets. Yeah, very much. Even since we launched, we've been saying, look, we've got really interesting markets. We think they're growing faster. We've got really interesting markets. We think they're undercovered and there's lots of alpha. And look, these markets are very correlated. And so therefore, you can get this really interesting, fairly low risk in aggregate portfolio from these countries. And yet they're trading on cheaper valuations than you find in the rest of the world. And it's not it's a story I've told so many times that it's sort of not new anymore. I've repeated it, but we really believe that it's still true. That you get markets, more alpha, better beta, lower correlations, and you get all of that at valuations which are still at historically relative lows versus more developed markets. So no, I don't think these markets are discovered yet, and I don't think they would make up a substantial percentage of really anybody's portfolio at the moment, despite being home to something like a third to a half of the world's population. So I think they're still in that underdiscovered bucket in all likelihood.
One thing which might strike sort of a chord with some investors, might flash some warning signs, is obviously some of the changes that Donald Trump is making, particularly to his tariff policies, also his attitude towards nearshoring, friendshoring, countries like Mexico, we've obviously heard a lot about, but countries like Vietnam potentially could end up the losers in all of this. So that must be something that you're watching very closely.
Yeah, definitely. We were definitely watching global trade policy really closely. And it's interesting, I guess, that you brought up Vietnam, which probably is one end of the spectrum in terms of percentage of exports to GDP, so openness of its economy. I think in global terms, it's really right at one far end. And the reason it's there, I think, is because Vietnam has huge manufacturing advantages in terms of cost of labor, in terms of education of population, in terms of age of population, in terms of already having quite big manufacturing hubs, fairly cheap electricity, location of the country, anywhere you're close to access to a port. There's a lot of huge structural advantages it has there. And those aren't going to go away over the medium term. And so likelihood is it probably remains quite competitively advantaged for manufacturing. And frontier markets actually has all the way down to, the right opposite end of the spectrum, in Argentina that's fairly closed, exports some grains, not a lot else at the moment. Would love to do more oil exports, but, and let's hope they come through over the next few years. Indonesia, close to Vietnam, actually is, again, would love to do more manufacturing because they're quite closed in. So, yeah, it's really a question, I think, of understanding all of those dynamics, and then being able to understand what's happening in the global environment, and see, what's priced into these markets, what's expected, what's not expected, and using that to find opportunities. And we'll see what happens in tariff. I don't have any more of a crystal ball, I think, than anyone else on that one. Obviously, some countries will be more or less advantaged, but what we have been saying over the last few years is that, we have increasingly seen a world that's split into three. So we have the East on one side and we have the West on the other side. And then we have this huge number of countries that are sitting in the middle, which are, to all intents and purposes, I think, trying to align themselves with no one, and a lot of the countries where we invest are those countries that would really like to remain on good trading terms, with the world in general. And these are low-cost manufacturing destinations, which I think in the current environment are still really likely to do well, as we see outsourcing from the East moving to other countries in the world. We see companies, I guess, in times of increasing uncertainty, trying to diversify supply chains and just take out some of those supply chain risk through diversification. I think actually a lot of the countries in the middle are quite well set to benefit. The other thing I'd say on that is I think in this world in three scenario, the other countries set to benefit are perhaps some of the places in the Middle East, where those countries are increasingly being seen as a good place for one to store one's wealth in an increasingly fractious world. And we've seen something like, the UAE property market do extremely well, as a number of investors have looked to it as a new financial haven. It's a country that managed to stay open almost the whole way through COVID. In terms of trading, in terms of time zone, it sits very well. Luckily placed, I guess, as an area for communication between East and West again. So we've seen that property market do extremely well. We've seen quite a lot of development over the past few years on the social side as well, I think, for a number of Middle Eastern countries. And so I think a lot of the universe that we have is really well placed if we expect what we have seen in terms of geopolitical fragmentation to continue, albeit there'll probably be some winners and losers, in the short term.
And just one final question before I let you go, because I know that some investors are nervous about closed-end investments. What would you say to someone that's never considered them before?
I think I'll go back to what I said, on this just being a great structure for the universe that we're investing in. And for us, it means that we are able to move capital into exactly the countries that we want. We don't need to be benchmark and liquidity aware in where we're investing, but we can take investors' capital. We can have a 3 to 5 year time horizon, and we can own exactly the countries and the companies, that we think the trust should be investing in. And so we feel that it gives us the ability to just take that slightly longer time horizon and therefore to make better investment decisions, and at least gives us the tools to be able to do that. Obviously, we can't guarantee that we will make better investment decisions, but it gives us the tools to be able to do that because of the structure of the closed-ended funds. So for frontier markets, for this less liquid area, it's really fantastic. But I would caveat that with, this is a trust, or add on to that, caveats of one way, but I would add on to that, we are hard currency investors. There is a very tight discount control mechanism on the trust in that the board have promised that every 5 years they would offer all investors the ability to exit at NAV less costs. And we reached the end of our third 5-year term at the end of 2025, and so February 2026, any investor will have the ability to exit at NAV less costs. So it's a very tight discount control mechanism, and in the last 2 5-year lives, that's proved a very good pool to maturity. And then the final factor just being, this trust actually is offering a really interesting yield. The benefit of frontier countries trading on very, very low multiples is that you therefore the inverse of that is quite a high yield. And so the yield on the trust is nearly 5%. And that's not from anything we do. It's not an income seeking trust, but it's purely a function of the way trusts are set up and us just paying out the income. So those reasons, I would say, actually make the structure really, really attractive and also a benefit for investing in these countries.
Emily Fletcher from BlackRock Frontiers Investment Trust. And don't forget, we've also got a series of special podcast episodes digging into investment trusts and also a new series of deep dives, the latest looking into the ongoing appeal of AI, of all things. You'll find them wherever you found this podcast. If you haven't already, do seek them out. Okay, Charlene, I've done loads of talking. It is now your turn because tax year end is a couple of days out. Let's do a really quick run through of what is reset.
Yeah, no, I do feel like I've been talking about tax year end quite a lot lately. So no changes to ISA and pension allowances. And as we've all become rather familiar with, tax thresholds and allowances will also be staying frozen. Now, when we think of our ISA allowance, that £20,000 across all ISAs, and the capital gains tax allowance, so the amount of gains you can make on investments that aren't already wrapped up in an ISA or a pension, they're really a case of use it or lose it. There's no carry forward available. And also thanks to that kind of standard pension annual allowance being £60,000 a year, although you also have an earnings limit on what you can pay in personally, most people probably won't need to make use of the carry forward that's available for pensions, but it is an option for some. And if you think that might affect you or you're considering it, we have got some really detailed information on our website and articles there. So rather than tax year end, really, I kind of now, we're recording Wednesday afternoon, the 2nd. Let's think about the start of a new tax year. And from a kind of financial advisor point of view, using allowances early where possible is usually the done thing rather than wait for that kind of tax year end rush. But of course, you've still got a couple of days to use up any of those allowances, particularly the ISA one, if you're still thinking about it. There will still be clients who have lumpy earnings, lumpy income. So, sometimes you do need to wait, particularly for pension contributions. But for ISAs, I think sometimes it's all about getting in there early. And I mentioned kind of other members of the team. And Lath's been doing some number crunching on using your ISA allowance at the start of the tax year versus the end of the tax year and whether that could put you on the front foot. And actually 1 in 5 of our own AJ Bell customers who max out their ISAs typically like to do this as well. And yeah, as I mentioned, Lath's look at the potential financial advantages to doing so. And he showed that an early bird ISA investor who's been paying in £5,000 a year would be nearly £20,000 ahead of someone who did it at the last minute of the tax year every year if they were investing in the same global equity fund since 1999. So think of the same type of fund, the same amount paid in, £5,000 a year, but just earlier in the tax year. And also kind of beyond that potential for high returns, you could even save more tax. So we know and love the ISA as a tax wrapper. And that early bird tax advantage could be especially valuable now because the annual amount you can get in dividends tax-free is cut now all the way down to £500. So if you think about a higher rate taxpayer who's already used their £500 dividend allowance elsewhere, making that £20,000 early bird contribution into an ISA invested in a portfolio yielding 4%, would actually save them £270 in dividend tax compared to putting investments in an ISA at the end of the tax year. So as I mentioned, we love the ISA due to its tax-free status and, we think it could be simplified further, but it is relatively simple when it comes to financial services products. If you're holding investments outside of an ISA still, you might, in the new tax year, consider putting them inside the tax shelter sooner rather than later. And we've mentioned bed and ISA on the program before, and that just means selling an existing investment and buying it back within an ISA. So your provider can do that for you, usually on things like UK listed shares within one transaction. So now, at the end of the tax year, if you did this right now, you wouldn't be able to get the sale proceeds into your ISA, probably, into a new investment before tax year end. But it's a way of using that allowance kind of early in the new tax year. And actually, the vast majority, again, we've been looking at what our customers have been up to. The vast majority of our bed and ISAs at AJ Bell consistently happen in the first couple of weeks of the new tax year. Now, I should point out that obviously selling an investment that's currently outside of an ISA will count as a chargeable event for capital gains purposes. So you do want to try and stay within that £3,000 annual tax-free CGT allowance wherever possible.
Now, with frozen tax thresholds, which we've spoken an awful lot about, that lovely term fiscal drag, there could be people that have been pushed into new tax bands, or maybe they find they're being pushed out of things like child benefit. And I know that that is where pensions can work a little bit of magic.
Yeah, definitely. So, most listeners will be aware that money you pay into a pension yourself gets tax relief. So if we're thinking about pensions like SIPs, the money you pay in gets some tax relief automatically. So that's the 20% basic rate. So the way that works is for every £800 somebody pays in, we reclaim £200 from HMRC, meaning a total in the pot of £1,000. Now, if you pay tax at a higher rate on your earnings, then you can claim more tax relief back directly from HMRC too. Now, that's really useful for someone who is just over where that higher rate tax band starts. Perhaps in the past they've been further away from it, but as wages have increased and those bands have stayed frozen, they've now tipped over where that band starts at £50,270. So your income over that, you will pay 40% on the slice of income that starts over that amount. So if we think about someone earning, £2,000 over that, so £52,270, they'll pay 40% tax on that £2,000, equal to £800. But paying in £1,600 to a pension like a SIP would get them automatic tax relief of £400, meaning an extra £2,000 in their pot. They'll also then be able to claim £400 back from HMRC. That will come to them directly, meaning they've got £2,000 in their pot for a cost of £1,200. But as well as this, pension contributions also reduce the taxable income figure that's used to test whether you qualify for child benefit, as you mentioned, or if you're at that £100,000 mark, whether you get all of your personal allowance, that tax-free slice of income. Otherwise, once your income tips over that amount, it starts to get tapered away. Now, £100,000, it has been all over our beloved TikTok lately, something I've talked about a lot in the past, because that's also the start of that cliff edge where you lose entitlement to tax-free childcare and a certain amount of free hours for childcare support. And, we've talked about that before, as I've mentioned. So if you've got your total taxable income for this current tax year in the last couple of days, and you are actually going to tip over one of these frozen allowances, making a pension contribution can boost your retirement pot with the help of tax relief, as I've mentioned, but potentially also get you back some of that child benefit or your personal allowance too.
And it is worth flagging when we're talking about tax that HMRC have announced that interest on late payments is going up.
It is. So this was something that was included in the autumn budget as part of new powers to HMRC, but it was actually, buried the day after last month, I should say, spring statement in terms of the actual rate it was going to be and a reminder of the rules, if you like. So it's not really been picked up that much. So from the 6th of April, HMRC will be able to hike late payment interest to 8.5%. Now, that's 4 percentage points above the current base rate, and that is thanks to those new powers granted to it by the government. Now, that's on sort of tax unpaid once you've got past that point, but the gap between what it charges taxpayers in late payment interest, so that could soon to be 8.5%, and the rate it offers on tax that you've overpaid will actually be wider than ever. So the rate that HMRC would pay you on tax you've overpaid stays at 3.5%, a full percentage point below the base rate. And there's also a slight difference in when these rates start to accrue as well. Pretty much straight away, I'm led to believe, for those who don't pay their bills on time, but it can be up to a year after tax overpayment. So I will leave listeners to make their own conclusions there.
Yes, well, not a surprise when we're talking about HMRC. And let's just round up with changes to potentially deposit protection limits.
Yeah, just something I wanted to kind of finish on. So we've seen proposals come out from the Prudential Regulation Authority, the PRA, to increase the FSCS deposit protection limit from its current £85,000 per person per banking license to £110,000 in December. So we'll definitely be keeping an eye on that one, and we'll keep you updated once we know more.
Thank you, Charlene. And just to say, if you do want a more in-depth discussion about tax year end, do listen to our sister podcast, AJ Bell Money Matters, which is aimed at helping women feel good investing, but has great tips for all investors and would-be investors. Now, gilts have been one of the most popular places for investors in recent months. So we dispatched Dan Coatsworth to talk to an expert about UK government bonds and the broader world of fixed income. Dan met up with Ryan Myerberg from the Brown Advisory Global Sustainable Total Return Bond Fund to get the lowdown on what's happening in this part of the investment market.
Most people might be familiar with sort of an equity fund. You might make 5-10% a year, on average over the long term from an equity fund. But a bond fund, would you be looking at sort of 4 or 5%, do you think, a typical bond fund in terms of annual returns?
So this strategy, what we look to deliver for clients is to return 2 to 3% over cash on an annualized basis over an economic cycle. But one of the challenges as a bond investor is that, we invest in a very asymmetric asset class where your upside can be relatively limited, but your downside can be zero. And so investors, we believe, really want to, have that sort of asymmetry of returns. So for us, what that means is, protect capital in those challenging markets, and then over the long term, really be able to lean into the opportunities where you have the big years. And then as you sort of average those out over the course of a 5 to 7 year period, then you can get that cash plus 2 to 3% returns, but on a very strong sort of risk adjusted basis, so smoothing out the volatility for investors.
I mean, if we look at sort of the current state of affairs, it kind of looks like we're in an environment where interest rates might stay level or be cut by a small amount, certainly in places like the US, UK, Eurozone. But is that sort of a favorable environment for a bond investor, or actually is not what we want to see?
I actually think it's a great time to be a bond investor. Now, I think maybe to take it to the highest level, we have lived through a very challenging environment for fixed income since 2022. Certainly the hardest market that many of us have ever seen in our careers. And the silver lining to that environment is that yields have moved a lot higher in bonds across the world. We went from a period of time post the great financial crisis where yields were zero, negative in lots of parts of the world, to a place where now that central banks have hiked rates around the world, that there is income again in fixed income. And that's great for clients. Fixed income can provide that steady stream of income for them. And a lot of the long-term returns in fixed income do come from income, that you receive on your investments. In terms of rate cuts, our view is that rate cuts will continue to come around the world, from the US, from the Bank of England, the ECB, other countries, as growth continues to slow. And central banks can use interest rates to help to stabilize economies. That's really good for bond investors. As yields go lower, prices go higher. And so there's a capital sort of appreciation opportunity for investors. To be fair, though, not every part of the yield curve is the same. Where we think the opportunity really lies is in the front end of yield curve. So say the 2-year point out to the 5-year point, because those are the points of the curve that are the most sensitive to the changes in interest rates. And so in this environment that we've talked about, where rates are going lower, we think there's really attractive absolute returns that clients can receive from fixed income. But maybe the best thing for bond investors today is that bonds are really showing that they can be a stability asset again. That as inflation has come down close to target in most of the developed world, that bonds are acting again with that sort of offset to equity risk. And so there's a really important role that fixed income can play and bond investors can provide for their clients in terms of that stability asset again. And so it is actually a really favorable time, in our view, to be in the bond market. And there's just so many opportunities globally for us to be able to harness on behalf of our clients.
Yeah, because I think certainly in the last sort of 2-3 years, a lot of people had a bit of a shock if they've held bonds, thinking that, if equity markets, wobble a bit, bonds are there to act as a cushion. But we didn't always get that. Was that like the scenario in which we were in was just completely unprecedented and not normal. It's quite encouraging for you to say that we're perhaps going back to a bit more stability now.
Yeah, I think 2022 was really scarring for a lot of investors. I think we all would have looked at our portfolios and the equities we held and the fixed income we held, and nothing performed. And it was almost a once in a generation type of event. We really hadn't seen that type of environment since the late 70s and 80s when you had the big inflation shock around the developed world. And there's a reality that when you're in an environment like 2022, where inflation is very high and growth is slowing very quickly, and it was sort of around the world, that all asset classes sort of perform the same. So equities were going down and yields were going higher, and risk assets and fixed income like corporate bonds weren't performing. And that was very, very challenging. But we've kind of come over the peak of that inflation cycle, and we're now to a much more normalized environment. Inflation's still sticky, but we are seeing that disinflationary trend, or inflation coming lower in most parts of the world that we look at. And that's actually a really healthy place for fixed income. That's a much more normalized world. And we are seeing, these flashpoints in the global economy when you've had periods of stress. You think back to last summer where, you had this big unwind of the Japanese carry trade where, risk assets, equities really suffered. Fixed income did really, really well. Even to start this year, fixed income markets are up. If you look at the S&P or the NASDAQ, they're down. And so that, again, kind of suggests to us that we're back to a more normalized world where fixed income can act as that stability asset. But it's not all parts of the fixed income market. And I think that's really important, is that if you own certain asset classes like high yield or emerging markets, they do tend to trade much more in line with equity markets. Whereas gilts or bonds or US Treasuries, the more defensive part of the fixed income universe, is the part that will perform and give you that counterbalance to the equity risks. And so it's been challenging. But again, I think it's created some really significant opportunities for investors to be in fixed income as a part of their overall asset allocation mix.
I mean, I've certainly seen quite a bit of interest from UK retail investors in gilts over the last sort of 6 months or so. I think that they would, particularly in the sort of the low coupon, short dated gilts, because clearly it looks like that people are trying to own them in hope that the price will go up and they'll make sort of a capital gain. I mean, have you got gilts in your portfolio, or what do you think of them at the moment?
We do have gilts in our portfolio, and there is sort of an interesting difference between how a retail investor might think about gilts today versus how we might think about it. And I think that, gilts for a retail investor, given the tax sort of implications, have created this really interesting environment where you had these very low coupon gilts. The prices have come down very materially as rates have gone higher. And so investors can buy individual gilts in their portfolio at low cash prices or low prices, take advantage of them as they move back to par and not pay tax on that. And so that's actually been a really interesting place for investors to be in the gilt market on the retail side. For us as fund managers, it's slightly different. We really think about it in terms of, the relative opportunity in gilts versus other markets we might look at. Less so on the tax side. But we think gilts are really interesting now. The market has sort of looked at the Bank of England and treated it probably much more like the Fed, perhaps, than, say, the ECB in terms of where monetary policy is likely to go. Our view is that the UK economy is and has been slowing pretty materially. We don't really see huge upside to growth from here, maybe stabilizing, and we see inflation moving lower. And so we do expect the Bank of England to cut more than the market is expecting over the course of this year. And what that does is it creates a really interesting return opportunity in gilts. Again, I think it matters where on the yield curve you own it. We tend to, again, favor the front end of the yield curve in gilts. But we think that the MPC over the course of this year will be slow and steady, measured, but will continue to cut rates in order to help to stabilize and to stimulate the UK economy.
Yeah, I must see. Donald Trump returned to the White House has caused, a lot of volatility across financial markets, and with the trade war issue still seems to be playing out. How is that impacting bond markets, and what have you been doing with your portfolio?
It is a very uncertain world. I think Trump being elected for the second time has created a massive amount of unease in terms of how the U.S. will act as a partner, whether it's in trade, whether it's sort of on a more geopolitical, from a geopolitical perspective. And it has created, a lot more volatility, frankly, because Trump 2.0 has echoes of Trump 1.0 in terms of trade policy. But the first time around was really focused on China. Now it's focused on China and everybody else. And the way we think about sort of the trade war aspect is that it impacts every country differently. We view trade wars and tariffs in the US as probably more of an inflation story, whereas tariffs on the rest of the world is really a growth story. And it's really why we've sort of shifted a lot of our exposure out of the US to other parts of the world, like the UK, like Canada, Australia, New Zealand, the Eurozone, where we think that because growth will really be challenged by tariffs, that central banks will have to act much more aggressively to help to support their economies. The other thing that's been very clear is that in a world where the US is no longer the trusted partner and ally, countries are going to have to make decisions on an individual basis in order to defend themselves. We just saw it really clearly post the elections in Germany, where the Germans, after many, many years of running a balanced budget, have decided to go ahead with a almost €1 trillion spending plan on defense, on infrastructure spending. And that has implications for bond markets. What it means to us is that there'll be a lot more bond supply in the market. It tends to be how you pay for these programs as you issue more debt into the market. And it's really put upward pressure on longer dated maturities in Europe. We've seen it in the UK. And so it creates volatility. But I think the important thing about volatility is it sometimes can be used as a negative term because it means things are uncertain. But for active managers, volatility really means opportunities.
That was Ryan Myerberg from the Brown Advisory Global Sustainable Total Return Bond Fund talking to Dan. And that's all we can squash into this episode. Next week, we've got Dan and Laith here to be in the hot seat, and they're going to assess the fallout from whatever Donald Trump has pulled out of the hat.
Yeah, do remember to get in touch with any suggestions of topics you'd like us to discuss or guests who you would like to talk to. You can email us podcast@ajbell.co.uk. Until next time, thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.